Imagine trying to access your bank account only to find out that you are unable to do so. You contact your bank and you're seeking for some explanations. Yet the bank tells you that your account is no longer available, that your account is closed, and they're waiting for you to provide with an alternative account in another bank so they can send the money into that account. Or even worse, the funds in your account are frozen. How would you react? For a lot of people, this would be an unpleasant surprise. Their bank to close their account without any notification and without any explanation. Before we go further, let's understand that yes, it's a very frustrating situation. It feels unfair. Losing access to your account can have a lot of severe and adverse consequences on your financials. On the other hand, the bank doesn't provide a clear explanation, and the decision is one-sided. So why does this happen? First of all, we need to understand that banks don't close accounts randomly because they want customers, they want business. That's how they do profit. So there must be valid reasons for them to refuse services to a customer, or even worse, terminate a business relationship with an existing customer. And before we look at the reasons, we need to acknowledge something. The fact that, like any other business, you cannot tell a bank with who to do business with. So yes, the decision to terminate or refuse services to a customer is at least not random. Because banks make decisions based on whether they are comfortable with accepting or maintaining a business relationship. So before onboarding a client, they need to understand the level of risk they are taking on by establishing this business relationship and the effort or the cost required to maintain a business relationship. For example, they will reject or exit a client when the risk associated with that client is higher than what they're willing to accept, or when the effort required to maintain the business relationship is too high and costly, meaning that when the customer is outside the risk appetite of a bank, then there is a high chance of the bank to refuse the services to these clients. Now, what is the risk appetite? Is the amount of risk a bank is willing to take, or any other institution, any other company. Is the amount of risk that they are willing to accept in order to pursue their objectives. Maybe now you ask, how do banks make profit if they don't take any risk? There is a difference between accepting a risk you can afford and accepting a risk that you cannot afford. And this is where the real reason lies, why banks often choose to close accounts that their customers may maintain even for many years. Let's not forget that banks are heavily regulated. They are required to comply with strict industry-specific regulations. Many of them do not apply to all other types of businesses. They apply only to institutions that are subject to supervision. And if they fail to comply with these regulations, the consequences are serious. And we are not talking only for banks, but any other regulated business, any other business that is subject to strict regulatory requirements. Failure to comply with regulations may lead to large financial penalties, restrictions from their supervisory authority, reputational damage, and if reputation is lost, it cannot be easily restored, and at extreme cases, loss of license. Let's give an example. One of the main obligations of banks is to comply with anti-money laundering regulations because they are required to prevent and detect financial crime. They need to have systems in place, controls in place to be able to understand and identify potential suspicious activities that may be linked to any type of financial crime. Financial crimes such as money laundering, terrorist financing, fraud, and other types of criminal activities. So it's part of their day-to-day job to understand who their clients are, how they generate their funds, and what is the risk of the customer being abused, either willingly or unwillingly, for any type of financial crime. Yes, it is a regulatory requirement. And this this is an example, of course, but a very good example to understand how risk really appears. So for each client a bank or any other financial institution maintains, they need to be able to answer some specific questions. First, do we understand the risk associated with that customer? And second, can we manage that risk? Do we have the appropriate systems and controls to onboard that client? Or is the risk too high? Now, what type of risk? The risk that the account may be abused willingly or unwillingly for financial crime. The risk that the customer's activity may not be fully understood or explained. The risk that the bank may not be in a position to identify potential suspicious activity, either because the customer is too complex or the transaction, the activity of the customer is something that the bank cannot fully understand or explain. And last but not least, the risk of the cost of maintaining a business relationship is higher than the benefit. And this is important to understand because the fact that the bank refuses services to a customer or terminates a business relationship with a customer doesn't mean that the customer has done something illegal or that the customer is involved in some type of financial crime. In most cases, they are not. Accepting or refusing services to a customer is a business decision, as already explained. You cannot tell a business with who to do business with. In reality, in many cases, when the risk is high, the banks choose to continue the business relationship with high-risk customers. They do have the systems and controls to do that. Often, they accept high-risk customers, but they implement additional measures such as frequent ongoing reviews of the customer, additional transaction monitoring and checks, all depending on the level of risk for each and every client. Again, even in high-risk cases doesn't mean that the customer has done something illegal or that the customer has done something wrong. It simply means that the bank has identified a level of risk that requires additional effort, a level of risk that requires more attention on their side. Now, another question. Why don't banks provide clear explanations to their customers when they choose not to offer services? Because in some cases they are limited by law on what they can say. Providing too much information may interfere with how they comply with their regulatory obligations. So the explanation you may receive in such cases may be limited, if any. And of course that makes the situation even more frustrating because you are not being told, you are not being provided with the full picture on what's going on. Now let's give an example to make it more practical and understand how banks assess and manage risk. Let's say there is a business that operates with cash, like for example, a restaurant or a kiosk or a cafe. There's nothing illegal in these types of businesses, and the fact that they generate cash is something normal. It's part of their day-to-day work. Nothing illegal indeed, and the banks know that. But from a bank's perspective, the fact that funds are generated through that business means less visibility. And when we say less visibility, we mean that cash is harder to trace. The bank or the financial institution cannot link each deposit to specific sales of customers when they are in cash. The source of the funds is harder to verify, whether the funds, those funds that run through the business, are the proceeds of legitimate or illegal activities. In such cases, the bank relies on the customer's records, but it cannot independently confirm each transaction. The bank sees money coming in, but they cannot see exactly how these funds were generated. And when they cannot link the cash with a specific activity, the risk becomes harder to manage. Does it mean that bank will refuse services to a cash-based business? In the vast majority of cases, banks do open and maintain accounts with cash-generating businesses. They accept this type of businesses, but they may apply a bit more scrutiny to ensure that the business is operating in a legal way. There are cases, however, where the bank assesses the risk associated with a client, maybe a client in another industry, and they may decide that this customer is outside our risk appetite. We don't want to work with that customer, either because they are not comfortable with that uncertainty or because the cost of maintaining this customer is too high. So it's up to the bank to decide whether the relevant risk is within their risk appetite and continue the business relationship, or that it's outside their risk appetite and they may choose to refuse the services to a client or terminate an existing business relationship. It's a business decision. It sounds unfair, especially if there is no explanation or the explanation is not clear or doesn't make sense. So the next time you hear a bank closing an account, do not assume that they did it without a reason. There was definitely a reason, but they not be allowed to tell you what the reason is. Remember, banks and other financial institutions are businesses, and you cannot tell any business with who to do business with. In many cases, it's simply a decision that the risk or the effort required to manage that risk is more than the bank is willing to take on.